Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special investing report brought to you in association with the BNZ. Today we look at the New Zealand Superannuation Fund, or some people call it the Cullen Fund. It was set up in 2003, it's been going for 7 years now, and it's back in the news again with some suggestions that it could buy stakes in state assets that are sold after the next election. And the obvious focus at the moment is on Kiwibank, but there are others, including Meridian, Mighty River Power, Genesis and Solar Energy. And we've seen action in the last year or so with the New Zealand Superannuation Fund teaming up with Infratil to buy into the Shell service station network. So they're doing things at the New Zealand Superannuation Fund, and it's worth having a look at how successful they've been, particularly in the last year of all the turmoil on financial markets, and also given the government turned off the tap, if you like, of fresh money coming from the government. So let's have a look at how it's gone. It's now up to $16.7 billion. The whole idea, of course, is to build up a significant stock of money so that from 2025 onwards, that fund could drip feed it back into the government and help pay for the pensions of all the baby boomers who are retiring. The whole idea is to perform much better than the markets, or at least much better than the risk-free rate. Now, the risk-free rate is judged to be about 6.1% at the moment. And up until a year or so ago, the fund was struggling a bit because of the big fall on financial markets, but it's performed better in the last year. So now, in the 7 years up until the end of April, the combined return per year after fees, but before tax, was 6.68%. It's above the risk-free rate of 6.1%. But of course, the New Zealand Superannuation Fund is aiming to do better than that, about 2.5% better than the risk-free rate. So there's some questions there. Can they catch up in the next 13 years or so before they're judged a success or a failure? Now, earlier we had an interview. Gareth Vaughan interviewed Adrian Orr, the Chief Executive of the New Zealand Superannuation Fund, and you can find it in a link below this video, in which he interviewed Adrian about the future of the New Zealand Superannuation Fund, how it's going and how it's run. But I just wanted to have a bit of a debate about whether it's worth the New Zealand Superannuation Fund continuing on at all, given that we're in this situation where the government is borrowing $240 to $250 million a week just to fund its deficit. The question is, are we better off putting money or leaving money with the New Zealand Superannuation Fund run by a bunch of fund managers, or should we use that money simply to repay debt or avoid debt getting bigger? Because one of the basic rules of financial advice really is that when you've got debt, you're much better off repaying that debt rather than trying to save money on the side. Simply the returns are much, much better off. And there's a real question there about whether all of that money, $16.7 billion, should be used to repay debt rather than being put into stock markets and various investments and having to pay for managers and hoping that you do better than 2.5% better than the risk-free rate of return. I wonder if it's worth a debate about that. I'm generally a supporter of the New Zealand Superannuation Fund, and it's helped build a real body of funds and body of expertise to invest in the New Zealand stock market. It gives the New Zealand stock market a bit of a chance. But in these times when it's all about debt reduction, can we afford to have the New Zealand Superannuation Fund? Would we be better off repaying the debt rather than putting that money into global markets? One to debate. I'm Bernard Hickey. That was the special investing report brought to you in association with the BNZ.